So now on to this evening's topic. So for nearly 2 decades, academics, public intellectuals, investment managers, and sometimes even ordinary investors in highly developed economies have been engaged in public conversations around what is the purpose of a corporation. Specifically, whether corporate directors should focus their energies and corporate resources on environmental, social, and governance, i.e. ESG, goals, even when doing so may adversely impact corporate financial performance and shareholder value. And the stakes at issue are really, really quite high. So our 2 distinguished speakers this evening, Professor Chris Tang on my far right and Professor Stephen Bainbridge, will address the broad landscape of ESG, both in the US and globally, and explain why the ESG movement, unlike the lackluster CSR initiative, is motivating action by corporations. They'll analyze this from the perspective of both an investor and that of a corporate director, and share their thoughts on whether ESG is indeed the road to a brighter future or a wrong turn in the history of the corporation and corporate governance. The expectation among the tables is that this will be a balanced discussion, and we hope that you'll be here to listen and learn and really sort of think through the issues. So now it's my great pleasure to introduce our 2 speakers here this evening. First, I'd like to introduce UCLA Anderson's Professor Chris Tang. Professor Chris Tang is a UCLA Distinguished Professor. He's the Edward Carter Chair in Business Administration, and he also serves as the Faculty Director, which is very fortunate for us, for the Anderson Center for Global Management, as well as the school's Senior Associate Dean of Global Initiatives. He's a foremost scholar of global supply chain. Professor Tang focuses his current research on social innovation in developing countries, identifying how companies operate in the environment to do good while doing well at the same time. He's world-renowned in the field of supply chain management and has been a consultant to numerous corporations such as Amazon, IBM, Accenture, and has published many books and is a frequent contributor and quoted in the Wall Street Journal, Barron's, Forbes, China Daily, among many others. And he's also been on the Anderson faculty for over 30 years. Professor Stephen Bainbridge is the William D. Warren Distinguished Professor of Law at UCLA. He currently teaches business associations, advanced corporation law, and mergers and acquisitions. Professor Bainbridge is a prolific scholar whose work covers a variety of subjects, but with a strong emphasis on law and economics of public corporations. He's written over 100 law review articles which have appeared in leading journals such as Harvard Law Review, Virginia Law Review, and Stanford Law Review. He's also written numerous books, including one of his most recent books, Outsourcing the Board, How Board Service Providers Can Improve Corporate Governance. He was also named 3 times by the National Association of Corporate Directors Directorship magazine to one of its 100 most influential people in the field of corporate governance. He's also been on the UCLA faculty for over 25 years. So whilst we'll begin with Professor Chris Tang, please join me in welcoming both Professors Tang and Bainbridge.
Thank you for the introduction, Lucy. Thank you. Good evening, everybody. I'm delighted to be here. So tonight's event is very interesting because actually I first declared that I'm not an expert in this field at all. As Lucy pointed out, I'm really in supply chain management. The true expert is sitting next to me. So Professor Bainbridge is truly the leading expert in corporate governance and also in the ESG movement. All right, so in that case, my role is to just tell you a little bit about what ESG is, how do we get here, and where we're going from here onwards. All right, so let me start. So the purpose of this talk is really talk about what is the purpose of the corporations. Now, in the business school, of course, this is a very important topic. That's why you're here. But for the law school, they're thinking, well, maybe we want to make sure they don't do bad things, right? So in that case, the question is that, well, where do we draw the line? So we started with the shareholder value system, and then how is it really the ESG is going to change that? Now, you think about the shareholder value, starting in 1970, this is a famous quote from Friedman. He said, well, the corporations are really supposed to make as much money as possible as long as they follow the rules, okay? The rules would be being ethical and legal. So it sounds great, right? What's wrong with that? But then the question is that, can we trust them to do the right thing? right? Now, actually, Adam Smith also pointed out that, well, in the free markets, you truly believe free markets, there is an invisible hand to make sure that these corporations will do the right thing. If they don't do the right thing, then the markets will punish them. So in the case, they cease to exist. So therefore, it should be self-corrected, right? Well, is it true? It sounds too good to be true, right? In that case, we don't have a job. Well, the law school will have nothing to teach, right? Because it's everything so good, right? Well, not so simple. Well, you look at this, we have seen a lot of corporate scandals. Besides the BP scandals, we have the Volkswagen, the Dieselgate episode. And then in the middle is about factories in Bangladesh. We outsource a lot of products to make in Bangladesh, and yet the factory owners, they really did not really secure the building, and then it collapsed. So actually over 1,000 garment factory workers died when they're making the Walmart product. Then, even during COVID, there's another problem. There are a lot of wage theft. There are over $500 million were not paid to the factory workers. And they list all these name brands. So many of these name brands, they are American brands. Then the question is that this is not really working. Then what can be done? All right, then move fast forward to the 80s. The 80s, this is not Friedman, this is Edward Freeman at Stanford. Then they said, well, we need to incorporate other people's value system into the process. That's where the stakeholders' value system came into play, and then he pushed for the corporate social responsibility. Again, it's also very good. You need to consider multiple objectives as a corporations. But then the question will work. Well, there's a Harvard Business Review article saying that it doesn't work. Why it doesn't work? First, they said the consumers, they don't want to pay for it. Let's say, suppose I'm green. Are you willing to pay more? Well, they have done a lot of experiments. Even the green products, most consumers, they would not want to pay more than 10%. Well, it costs money, right? So in the case, that is also one issue. The second issue is that it's not well defined. They don't even know what it is. If you don't know what it is, then you can do whatever you want, right? So in that case, that didn't happen. Then so, all right, if you say that it's not well defined, we are going to define it for you. So that's where ESG come from. Okay, so ESG, he said, okay, let's change that. He said, well, let us do the measurements. So this started United Nations. Make sure that they do the right thing. We define the measures. So in the case, we want ESG movement is about measurable performance in the environmental, social, and governance. Right? Are you green? Are you being ethical? Are you paying the fair wages? Do you have the diversity board members? That kind of issues, right? And you have to report it. The issue is why do we do that? Besides measurable outcomes, measurable actions, there is also a mindset shift. The younger generation, like all of you, really recognize the sustainability issues, the climate change issues. If we don't change the way we do things, the Earth will end earlier. So in the case, although that will not my lifetime, but you hope that will last a bit longer if we want to do that. And also being fair. Being fair, we feel that maybe we feel happier about ourselves, being fair. So that is that. And then also say, well, I think that the corporations are too powerful. We want to take the power back to the people, to the investors. That's why the investors say, well, we need information. We need the ESG measurements such that we can make informed investment decisions. Then we will support companies that will do good along these three pillars, the E pillars, the S pillars, and G pillars. Sounds also great as well. So in that case, what could go wrong, right? So, well, whenever there is opportunities, many people will come into the marketplace, right? That is where the money is. Wow. Well, by 2021, the global managed assets is on $33.5 trillion. This is assets under management. This is like your index fund. This is like your retirement fund and all this. But it's growing bigger. From 35, we just reversed the number, it's $53 trillion by 2025. Wow, so much money, then of course everyone wants to get a piece of pie. that's exactly what happened. So in that case, well, we need to provide the data, we need to collect the data, we need to rate the companies who is doing better than others, just like our business school ranking. We have more rankings than number business school eventually, right? This is what we see. So you see the list, right? The first one is MSCI, and then we have Sustainability, which is owned by Morningstar, and then we have Bloomberg. We're also Refinitiv, that is owned by London Stock Exchange. Then he said, well, we are going to have all these agencies, but then when you all this data, then who knows who is doing what? Well, that's why that we need to have auditors, we need consultants to help them to figure which one how to fill out the form, like our tax forms, right? So therefore, there's huge job explosion. In the business school, they cannot hire enough people. Even PwC, they're going to spend billions of dollars to hire 100,000 people like you to help companies how to fill out the form. Big money. So in that case, business school also changing. So everyone's happy. But then the question is that, is this the solution, or are we creating a new problem? How do we know that you are actually reporting the right data, doing the right thing? So we'll come back to that. All right, so then they create a lot of confusion. So now there's so many ratings, like our business school ratings. It turns out that different ratings, the correlation is very low. If you study the statistics, it is upon, well, linear regression is a regression model. This is 0.3. 0.3 is not so good, especially when you're measuring the same elephant, right? How come one measured elephant has the rating, the other has other rating? We always wonder. And then the other one is also the same thing, compared with MSCI and FTSE. There's no correlation. Then what are we doing? Then the next one, how about investment? Do you make more money? Well, that's another question. Well, if you look at the horizontal line, that is a baseline. If you follow the S&P 500 index, well, then up to 2020, it seems getting better. Well, we know that 2021, what happened to S&P index, right? So therefore, actually, they perform actually worse. Then the question, you're looking the wrong thing. Because the market or anticipate this company doing so good, then the prices are higher to begin with. But then at the end of the day, do you care about your return, or do you care just investing those money? For those companies, they do good in ESG. You be the judge. I don't know. All right. So the question is we have problems in terms of measurements, in terms of ratings, in terms of reporting. Because right now it's voluntary, it's not mandatory. Then the question, what can we do? So now SEC is coming up with regulations, recommendations this year, and EU also looking into that as well. All right, to conclude, then the question is there is a long way to go. It is a movement. Are we heading the right direction or another crash? I don't know, all right? I don't have a crystal ball. As I told you, I don't know anything. I'm learning by doing. I'm learning from him. So basically that when everything is not well defined, everything is in flux, that means opportunity to do good and do bad. I don't know. But then the companies also confused. We need to do it because many people pushing for it. But if you're a board member, what do you do? I don't know. So I asked him. So over to Professor Bainbridge.
Thank you.
Thank you.
Thank you, Professor Tang. It's an honor to be with you today. Your expertise on supply chain management is world-renowned, as it should be, and I can't think of someone who's better positioned to think about these issues because not only, as we all know, the supply chain issues are so pertinent right now, but also because logistics companies and other companies that are involved in the supply chains are coming under pressure to think about their impact, particularly on the environment and so forth. As lawyers, we're used to asking both ought and is questions. What should the world look like? What does the world look like? And I'm going to try to very briefly talk about both today. Let's start with the ought question. And a couple of common, I think, misconceptions. One of which is that the traditional model that required directors to maximize shareholder value is somehow going to destroy the planet. And if you think about it, directors, officers, of companies are not going to treat their stakeholders as automatons whose feelings, livelihood, health doesn't matter. They're not going to treat the environment as a dumping ground, not necessarily because they're acting out of their own goodwill, but rather because healthy employees are productive employees. There's a lot of evidence which suggests that most of the time, the best way to maximize shareholder value is by taking good care of your workers and the environment and so on. This second misconception, I think, is that ESG is going to be easy to implement. Well, maximizing shareholder value is pretty easy to implement, right? You ask some very simple questions about return and profits and so forth. But when you come to maximizing ESG, the world becomes a little more complicated. This is a fairly standard, or this diagram rather, represents a fairly standard list of ESG metrics. And as you can see, the authors or the drafter of this graphic couldn't get all 79 metrics into the diagram. Now, how would you prefer to make a decision? Would you rather have one thing that you're trying to maximize, or would you try to maximize 79? It's a lot harder, obviously, when you have 79 factors, many of which will be inconsistent with each other and require trade-offs, than if you have a single maximand that you're pursuing. The more serious problem, though, is not just that this is hard, but that it leads to an inevitable temptation. Suppose you're on the board of directors and you're presented with a decision to make, and one choice would be good for ESG factors 13, 27, 49, and the other choice would be good for ESG factors 2, 29, and 54. And you're sitting there trying to decide how to balance these, and it occurs to you that the first decision, would be a lot better off for you and your fellow directors and the managers of the company. Will there not be a temptation inevitably to say, well, we had to go with ESG factors so and so and so and so and so and so. And so implementing ESG is fraught with accountability issues. And nobody has yet figured out how to make the accountability problem that's inherent in ESG management go away. All right, well, let's shift gears for a few minutes and talk about whether companies are implementing ESG. And the answer is a lot of companies are talking a lot about ESG. But in my view, a lot of it, most of it, nearly all of it, is what's known as greenwashing. And I think there's a lot of evidence to support that. One study looked at acquisitions of 100 publicly traded corporations. These acquisitions took place during the pandemic, and they were all valued at $1 billion or more. Now, for those of you who are lawyers and have had my mergers and acquisitions class, you'll remember that we worked with about an 80-page merger agreement, and that there were numerous covenants and representations and warranties and conditions. And in this study, they found none of the agreements, not one, contained any representations, warranties, or covenants relating to stakeholder protections. Well, if companies are really all that concerned about ESG, shouldn't they have taken that into account? Many of you will have heard the Business Roundtable, which is an organization of 200 CEOs of large corporations, has for many years issued statements of what is good corporate governance in their view, best practices. And those have always included a statement of what is the purpose of a corporation. And historically, they said it's to maximize shareholder value. 2019, much hoopla. The Business Roundtable announces that we are embracing ESG, we're embracing stakeholder capitalism, and yeah, we'll make some money for the shareholders along the way. So some folks have been looking at the performance of the companies that are run by the CEOs who signed that statement. One study found that firms whose CEOs signed the statements had more federal compliance violations than the companies run by Business Roundtable CEOs who did not sign the statement. That's an interesting result, isn't it? Another result looked at, if you're a New York Stock Exchange company, you have to have a written set of guidelines on corporate governance, how you're going to do various corporate governance things. And so this study looked at the corporate governance guidelines of the companies whose CEOs had signed the BRT statement. None of those companies rewrote their corporate governance guidelines to incorporate ESG and stakeholderism. They all still talk about maximizing shareholder value. Well, if this was really all that important to them, you'd think they would have tweaked the guidelines a little bit. Pay. At the end of the day, most folks are motivated by pay. Are companies using ESG metrics in setting CEO pay? Well, this study looked at CEO compensation at the S&P 100. And they looked at it over a period of several years, and there's fluctuation in the number, so it's not exactly 100 companies. But of the companies they looked at, about 53% claim that they use ESG metrics in setting their CEO's compensation. Now, 62 of the companies that were in that study set had CEOs that had signed the 2019 BRT statement. But 26 of those firms, almost half, did not use any ESG metrics in setting CEO compensation. So even though their CEO had signed the statement, that CEO had no economic incentive to carry out stakeholder capitalism, ESG. The companies that do use ESG metrics exclusively use ESG metrics in setting cash bonuses. But on average, these companies, the CEO's cash bonus comprises only about 22% of the CEO's total pay package. So almost 80% of the CEO's pay package has no ESG factors going into it. Finally, how much weight do ESG factors get in setting bonuses as opposed to the traditional shareholder value financial factors? Well, the highest number the study found was at one company, it was 12%. The average was between 2 and 3%. So in other words, 20% of the CEO's pay gets ESG factored into it, but only 2 to 3% of that 20% is actually dependent on the CEO's ESG performance. And I'm not going to try to do the math in my head, certainly not in front of a bunch of half full of management students, but it's probably a very tiny percentage is going on here. Well, if directors aren't factoring ESG into their decision making, why not? Well, one possibility is that they recognize the accountability issues, and they recognize that until somebody fixes them, shareholder value maximization is the way to go. There are a bunch of other possibilities. I devoted, a very long chapter. I have a book coming out, pardon me. It's called The Profit Motive, Defending Shareholder Value Maximization. Don't exactly hide the ball on where I come out on that one. Coming out, Cambridge University. It'll be out in the fall, plenty of time for Christmas giving. All of your loved ones and relatives would probably enjoy it. I devote a substantial portion of the book to talking about why it is that I think companies are lagging on this front. And there are a lot of reasons, but here is the main one. It's that they're scared, and deservedly so. Now, you work with data. I'm a lawyer. I work with anecdotes. In fact, for my definition of data is, well, I got two anecdotes, right? Data is just the plural of anecdotes. So this is an anecdote, but I think it's a very telling anecdote, and it's what happened at Etsy. In 2015, Etsy went public as a certified B Corp. For those of you that don't know, B Corp is a third-party certifier that basically comes in and assesses you and decides whether or not you're kind to animals and small children and the environment and so on. And then you get certified as a B Corp. They went public as a certified B Corp. They were one of the first companies to try and do that. Their registration statement when they went public really emphasized, we're stakeholder capitalists, blah, 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 blah. And they had a CEO at the time who was really strongly committed to stakeholder capitalism. And all went well for about 2 years. And then Black and White Capital, which was a small activist hedge fund. You business school students presumably are familiar with hedge funds. For my law students, there's investment firms, and some of them specialize in being shareholder activists. And they have a set model. They identify a company whose financial performance is lagging, and they zero in on that company. They come in, they talk to management, they suggest that management turn things around, and if management refuses, then they start doing things like running proxy contests to vote out the incumbent board of directors and replace them with people that will focus on shareholder value maximization. So Black and White comes into Etsy, buys just 2%, and discloses, hey, we're here and we're shareholder value people. And not to be outdone, two other hedge funds the very next day, TPG Capital and Dragoneer, announced that they had taken stakes in Etsy, and that they similarly wanted to see Etsy, stop coddling stakeholders and start returning shareholder value. What would you have done, business students, if you were on Etsy's board of directors? What, law students, would you have advised your corporate client at Etsy to do if you were counsel to Etsy? Well, what did Etsy do? They surrendered. The dealbreaker.com website, business sort of scurrilous stuff, they harshly but truly said that Etsy flipped overnight practically from being crunchy hipsters to being Gordon Gekko in one afternoon. Some of you younger folks may not remember Gordon Gekko, but he was the villain of Oliver Stone movie Wall Street. And if you're business students and law students and you haven't seen that movie, you have to. It's part of your education. And there's a very famous scene in which Gordon Gekko gets up at this shareholder meeting and says, for lack of a better word, greed is good. All right? What did Etsy do? Etsy's board fired the incumbent CEO. They cut 8% of Etsy's workforce. They surrendered their B Corp certification. They hired a new CEO who was focused on shareholder value maximization. The stock price jumped. Now, I'm not saying that's a good thing. I'm not saying it's a bad thing. What I am saying is that this is a high-profile anecdote that is a story that has been repeated many times. And I think that, hedge fund activism is one of the big reasons why companies are lagging in this area. So I guess the question that I would pose for you is, is what's going on really just greenwashing? Or is this baby steps where eventually, business will figure it out and we will move on? But the main thing that I think that you ought to come away with is when companies start talking to you about ESG, take it with a grain of salt. Thank you.
Hi, thank you first of all so much for the great introduction. We're trying to make sincere baby steps in that sense, and one of the biggest obstacles we face is the supply chain we have. And it's not only diverse, we have a set of tier 1, tier 2, tier 3 suppliers, it's international as well. So question number one is to you, Professor Tang, how can we get transparency? How can we get the buy-in of all the entire supply chain really to report fair numbers, to make it comparable, apples to pears? And to you, Professor Bainbridge, from a legislative perspective, can we do this on a national level, or does it have to be a consolidated or collaborative international framework which is absolutely consistent to make this happen?
Thank you. Maybe let me first respond to the first question about supply chain measurements, right? Well, your question is right on. Let me use one example, Amazon. All right, we all know the company. They report the ESG data in terms of carbon emission. And they claim that their carbon emission is only 1/7 of Walmart. Well, depending how you count it. If you only count how much Amazon actually generates within the 4 walls, we call Scope 1. Scope 1 reporting is within the 4 walls, is much less. But should we actually count about in terms of the products that they sold through the third party on the marketplace? Well, that one was not captured. So in that case, even this statement is comparing apples of oranges. So now we discover that most companies, over 60% of the companies, they don't report the Scope 3 measurements, which is your supplier, like your logistics providers, because they're outsourced, right? And also made by the third parties. Then the question, how do we get there? Well, there are many obstacles. First, 80% of the American corporations, they do not know the identity of their supply beyond tier 1. They know tier 1 because they're account payables. They order things from you, you have to pay them, right? Of course they know that. But after that is that we don't care, right? So that's come back to his point. So in the case, how can we actually ensure that the company is going to even do due diligence to find out the supply chain identity? But change is on the way. Now, this is happening in Germany. Germany, actually, in last year, they just passed a law, the parliament passed a law about the Supply Chain Due Diligence Act. So they've actually, step 1 is requiring companies, big companies, to actually report even the identity of the supplier. This is a good movement. The measurements hopefully will come next, but they're not there yet. So I think that we have a long way to go. So I think that is why I think that this evening's event is fantastic. We want the business student to think about these issues, and also we want the law schools to think about, so we regulate, so we actually make this as a mandatory. Because right now, actually no one cares. But we know that a lot of dirty greenwashing issues occur. What Professor Bainbridge said is absolutely right. A lot of companies, they claim that they're green. Well, how do they become green so quickly? Well, that means you outsource the dirty one to your suppliers. So, well, see no evil, hear no evil. Then in the case, there's no evil to report, right? So therefore, if we can capture the entire supply chain, that would be better. But we are not there yet. But then the question is, how can we get there? No one knows. Thank you.
I would come at your question by mentioning that the big thing that's going on right now in the law, at least corporate securities law that I deal with, is the SEC proposal to require climate disclosure. And I'm part of a group that's working up a set of comments to reply to the SEC proposal. I have some serious concerns about the workability of climate disclosure, largely because of the issues you just raised. How do companies disclose? If we're going to require companies to disclose beyond their Scope 1 emissions, aren't we going to end up with a lot of duplicative reporting? How do companies measure, particularly Scope 3? How do they gather that information? Are people going to be able to sue over these disclosures? And I think that's where the action for me right now is what are ultimately the SEC going to do? It's clear that Chairman Gensler has the votes to ram something through. Hester Pierce is fighting a dogged rearguard action, but she's going to lose. But the question is, are they going to come up with something workable? And that's really up in the air at this point.
I just have a follow-up question, I guess, in terms of the SEC and the EU's kind of moves to at least start the ball rolling in terms of having these mandatory disclosures. And I guess my feeling is that if we can't rely on the corporations to do more than greenwash, how else can people who care, right, make these changes? I know there have been activist investors that have recently been trying to actually come in from the other end of the spectrum and try to make these changes and invest in companies that perhaps have slower growth but are, actually true to their ESG goals. And so I guess without disclosure at some level, obviously workable is the ideal, but we need to start somewhere. How do we actually change the system? And I guess that's open to both of you.
Yeah. I might jump on that one first. It's a great question, but the question is the securities regulation scheme the best way of addressing climate change? I mean, the SEC has extraordinary expertise in dealing with a small set of issues, but it is not the Securities and Environmental Commission. It's the Securities and Exchange Commission. And, is disclosure the best way at getting at the problem of climate change? Is disclosure something investors actually want? And one of the interesting things that I think about the SEC climate change proposal was the emphasis in the release on a very small subset of investors that kept talking about what Larry Fink wants. Well, I don't know who died and left Larry Fink in charge of climate policy. Larry Fink, for those of you who don't know, is the CEO of BlackRock, the huge ETF company. I think the best way of assessing what people want is to look at what they do rather than what they say. And the best way of assessing what investors want is to look at the results on shareholder proposals. Companies have to include these proposals in their proxy statements and put it up to a shareholder vote. And in 2022, the average climate change disclosure shareholder proposal got 30% yes, 70% no votes. So, I think put money into renewables, put money into nuclear, put money into encouraging, a transition to a carbon-free economy. I'm just not sure that the SEC is the appropriate agency for accomplishing a result that we all ought to want, right?
Yes, so we have one question from a remote participant who's anonymous. Who should be the enforcers of ESG, and who should watch the watchers?
You're the lawyer. Well, I think that's a very good question. Who should be really guarding this kind of movement? I read something from the Harvard, the Corporate Governance Forum, and they claim, this is one report they issued, they claim that SEC to take a more active role. That means that because you remember how SEC was formed, it was after the crash of Wall Street. So it was started in the 1930s. So the role, the responsibility of SEC, they have the power to ensure ensure the free and fair and also trade markets, and also protecting the investors as well. So I think that if we try to go down this road, this path, I think SEC should take a more active role and come up with specific guidelines, because right now it's voluntary. Worse, even a lot of data is self-certified, which I find it rather shocking, assuming that we don't trust corporations. So in that case, that means that SEC must take a more active role. That's my take.
Yeah. Well, I'm going to respectfully dissent. The problem is that ESG is not one thing, right? It's environmental, it's social, it's governance. Governance is questions like, should companies have a staggered board of directors? Should companies have a poison pill? Should companies have one class of stock with one vote per share? Or should companies be allowed to have dual classes of stock where some shares have more votes than others? Those are governance questions. And candidly, in the law, most governance questions are actually none of the SEC's business. They're assigned to state corporate law. All the ones I just ticked off are state corporate law questions. Social, right? The SEC has wrestled with disclosure relating to social issues mostly unsuccessfully. And particularly, one thinks about shareholder proposals relating to employment. And the SEC's track record there is not a very strong one. And so then you think of environmental, and as Hester Pierce said, they're not the Securities and Environmental Commission. So, I think that when we talk about ESG, we're talking about the full panoply of the regulatory state. You have to be. And the SEC's chunk, I think, has to be pretty small. But, the EPA, the Department of the Interior, et cetera, et cetera, et cetera, I think that those are the folks that you're looking to regulate in this area more so than the SEC. The SEC, in my judgment, does best when they stick to financial disclosures, regulating markets, and their track record in dealing with all the rest of this stuff is just pretty shoddy.
Yeah, thanks so much for the discussion. I have a question that's sort of based on my impression of sort of more the public's discussion of ESG issues. So it seems like things like climate change, labor relations, what have you, those are sort of policy questions. And I guess I'm curious on your thoughts on, now there's so much of an expectation that the private sector will do a lot to kind of lead the way in terms of a lot of these policy questions. So what are your thoughts in terms of like the appropriateness of that, or what that means maybe? Does it just mean we have an impotent federal government perhaps, that kind of thing?
I think that's a wonderful question, and another plug, it's actually something I talk about a lot in my book, which will be available for Christmas giving. What you raise is one of the great ironies and long-standing debates going back into the 1930s between people who thought that government's not stepping up to the plate. And if we look at Washington, I don't care what your politics are, you can't be happy with what's nothing's happening in Washington. And unless you're a hardcore libertarian, you might think that's not a good thing, that we are so polarized that basically nothing happens. And so, okay, let's have the private sector step up, particularly large corporations. On the other side of the debate, there have been people who say corporations have too much power. You know, and one of the interesting things to me about this is I've been very interested in the history of populist movements as they relate to corporations. And one of the things that's striking is I could give you some quotes and ask you, okay, who said this? Was it somebody in Occupy Wall Street, or was it somebody affiliated with the Tea Party? And you know what? You'd be very hard-pressed to tell the difference. Who said, for example, corporations are too big and they are oppressing the American worker, treating the American worker like the word they went on to use is about excrement? Well, you might say, okay, well, it was one of those Occupy Wall Street guys. No, it was the head of the Michigan Tea Party, right? So that's the question that you're raising, is are you somebody who thinks that the corporations have too much power? Or do you think that corporations should be empowered to take on these social problems? And that is a profound question that I don't know that I have a good answer to. I tend to come down on the side of, you know, I think big corporations already have too much power. But it's a great question, and it's a fundamental question that you know, I think is what is driving a lot of the ESG discussion. And yet the irony is that the folks that want companies to step up to the plate ought to be also thinking about, okay, well, how much power do we want companies to have?
One more question from a remote participant. So who should regulate all of those agencies? The SEC, the EPA, the Department of the Interior? And how do we know they can generally lead to good outcomes?
Well, in theory, the president, right? You know, the president and the Congress. And whether that's going to lead to good outcomes, I would leave to your own politics.
Well, maybe supplement a little bit. In terms of rating agencies, I've spoken with a couple of them. Right now, the data collection is in the flux. A lot of data, they are from third parties, sometimes from the company itself, sometimes from NGOs. Now, but then who is going to audit those data? Well, it's kind of murky. Now, I think in Europe, France and Netherlands, they're pushing EU to change that in terms of data provenance. That means that they want the company to disclose where does the data come from, because right now we do not know. And then the rating agencies has enough problems. How they do the rating is a secret source. It's proprietary. So you don't know how the rating came about. If you don't know how the rating came about, how do you know how to regulate? So that's why right now a lot of the investors, they are shooting in the dark. Then the question is that what kind of risk is there? Who is responsible? Are they being misled? Can the investors sue them? That was a question posed to a lawyer. If I follow your rating, I invested money, I lost money. Then it's what, are you misleading me or not? Right now, I don't think the law has settled on that yet.
So I have a question, really directed to Professor Tang. Okay, I'm going to assume away your problems. You talked about the problem of we don't have the right metrics, we don't have a universal set of metrics that we all agree upon, and we don't have a way of auditing the numbers that the companies give us for these metrics. Assume all that away. We have a universal set of metrics, and we have a set of auditors, not unlike the fact that we have a set of financial auditors. They're just doing it, right? So you don't have that problem. Will investors care?
That is a very good question. Suppose that all the problems disappeared. Right. Then the question is, well, are you going to invest in companies truly do the true good ESG, or are you going to invest in a company that will generate more return? Which one is it, right? So I think that's right now, I think it depends on the generations. They did a survey. For the more older investors, they are more conservative in terms of they care much more about the return. But for the Gen Z and the younger generations, they did a survey. They do care about in terms of the environment, because I think that they do care about the environment, social justice, and also fairness and governance, diversity, and all these things. So in the UK, they also really care about in terms of the diversity on the board, right? So I think that is depending who you ask, right? So I think that the answer is yes and no.
Yeah, but here's the interesting question, and I think that's exactly right. But think about the impact of index investing on what you just said. Because if I'm BlackRock, State Street, and Vanguard, and I'm offering an S&P 500 indexed ETF, the investor's choice, presumably in investing in an index fund, is how close do they match the index, and what's their expense ratio? And so don't BlackRock and Vanguard and State Street have incentives, at least on their index funds, to keep costs down? And that's why I find it kind of puzzling that Larry Fink talks so much about ESG issues, because if he really is going to put BlackRock's muscle behind that, isn't that going to just raise his expenses and make his S&P 500 index fund less competitive to, say, Vanguard or State Street or Fidelity?
That's excellent questions. I think they are actually trying to see that is how to protect the investors in terms of investment, but also they worry about the risk. So right now they say, well, is putting the return aside. They worry about if companies, they do badly on the ESG dimensions, it can put them down. So they're not looking in terms of doing good. They worry about if companies, they do bad along the ESG performance, then the investors and the public will punish them. That goes back to the invisible hand syndrome. Then the question, is it true or not? Now that is a question. Even right now, there's a debate. What is a ESG good companies? For example, right now, you look at Northrop Grumman, the defense companies, the stock price went to the roof. Well, is this kind of making weapons, is this a good ESG measures? Well, depending on situations. And also in terms of oil company, right now, the stock price also went up. Right? Then the question, my God, we talk about climate change and all this. What is going on with the investors? I think that is a good question, Joe. Are we really put where our money we believe in? Right? So I think that's the question back to the investors. What do they really want?
Okay, I think we should be ready to move to the next part. First, please join me in thanking Professor Bainbridge.